and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then, Kalra of Target Investing, Sangeet Lakkar of Newberry Capital, and independent investment advisor Vivek Mavani join us on the show. Today on Hot Money, we'll discuss stocks like Maruti, Engineers India, Shankara Building and Manpasand Beverages. So these are the stocks that we will be discussing today. Let's start with the first stock, and that is Maruti. Significant amount of improvement that was seen as far as their May sales data is concerned. The stock has corrected significantly from levels of 10,000 a couple of months back. It's now reached levels of 8,700. So the big question we are asking is the data supporting for someone to go ahead and accumulate Maruti? So that's the big question we're asking. Sangeet, what did you make of Maruti's numbers and what's the view ahead? It's corrected significantly, but still trades at a substantial premium to its peers. But what if someone wants to accumulate Maruti? Is this the right time?
So I'm neutral to Maruti right now. It's a good portfolio hold. It's an excellent franchise and it's incredible what they have created over last couple of decades. They have been able to increase and retain their market share to more than 50%. Having said that, the valuation is Maruti is the most valued stock not in India, even globally. So on the valuation parameters, I'm a little neutral to this stock. Business-wise, yes, I mean, enormous opportunity in India. Right now, the auto sales are hardly about 3.5 lakh cars per month. China, you have sales of about 25 lakh cars per month. So opportunity is immense as the per capita income increases. It's important how Maruti is able to retain its market share, because you have to come out with new launches, refined versions, upgrades, electric vehicles and whatnot. So we'll have to see the transition, how it plays out. It's neutral at the current valuation.
Okay. Samir, I think last time we spoke about Maruti, you were quite bullish about the entire Nexa model and all. What's your view? If at this price, and that time the price was much higher, at this point of time, would you still maintain that view and someone should accumulate Maruti?
I would. See what happens if you see Maruti's last 5-year PE average valuation, that has been around 19.5, 20. So I think it's not expensive as compared to the historical average. If you see, standalone globally, it might be one of the highest, valuation kind of a parameter. But if you see the growth and the volumes they are churning out, I think that deserves that. If you see the Nexa model, what they have turned into, they have started buying 1,000-1,500 crore land into prime areas of cities, and they have been building up the Nexa showrooms and leasing out to the dealerships. So that reduces the capex end of the dealership. So that promotes much more volume to be pushed through. Second, their focus on the used car has increased in past couple of quarters, which will give them a very big upper hand on the margin side in the coming quarters.
Okay, so that's the view, one neutral view, one accumulate view, and what do you make of it, Vivek?
Well, I too share the view Samir has got in terms of, I think every decline is a buying opportunity to accumulate for a long-term portfolio holding as far as Maruti is concerned. I mean, if we look at India, the wide spectrum of stocks, very few companies can bet or very few companies have delivered consistency and sustainability of earnings quarter after quarter, year after year. And Maruti, it's been like now listed for almost 12, 13 years, probably even longer. And you have really nothing to complain when it comes to consistency and sustainability of delivery in terms of performance. Month after month, volume growth, quarter after quarter of double-digit earnings growth, top-line growth, bottom-line growth, free cash flows, return on capital, return on equity, all of it close to 25%, a debt-free balance sheet, and most importantly, a huge growth opportunity ahead over the next 5, 10, 15, 20 years. Valuation-wise, not too expensive when one looks at broad markets as well as Maruti's own historical valuations.
Okay, Vivek, your time is up. I'll come back to you. So I think the broad view we're getting is two of our guests are rather positive on Maruti. The Sangeet is neutral on it, not negative. So it's a positive view that we're getting in on Maruti. Just before we open it up for debate, there's a question that one of our viewers has written it. Barun Kumar is writing, why is the top line volume and EBITDA growing, but the growth is not so much on the profit front? And how does royalty and rupee depreciation affect Maruti? You want to take it, Samir?
So what happens, as you pointed out, the rupee depreciation doesn't help, it impacts the other way, because the royalty payments go in yen, and the higher the dollar, so we don't have a direct conversion from rupee to yen. So the higher the dollar goes, the more hit Maruti takes, and that's where even the valuations or the downside which has come has kicked in. The other part is they're doing a lot of capexes on the plant they have, so that is hitting the margin, hitting the PAT side of the end. So I think these two places are taking the toll on the whole exact PAT number, but I think it's better to be investing right now rather than creating an issue over there.
Okay, I think it's a similar way that you are sharing, Vivek, in terms of investing periodically in Maruti. I'll let you continue what you were saying because the time was up. And secondly, how is commodity costs which are rising and crude prices which are rising affect your view on Maruti?
Okay, a couple of things. In terms of I'll just continue with the gentleman Baron's comment as to why profits are not growing. Well, it was only in the fourth quarter that the market participants seem to have had a complaint with Maruti in terms of earnings not meeting expectations. But otherwise, I don't think there have been too many downgrades in the last few years as far as Maruti's performance is concerned. They have more than lived up to expectations. As far as the forex and crude impact is concerned, let's look at a longer term trend, which I would suggest for anybody to look at it. 15 years ago, rupee dollar equation was whereabouts of 35, 36. Today we are at 68, and in between we have had various cycles. Maruti has maintained on an annualized basis, maintained a certain range of EBITDA margins as well as PAT margins, cash profit margins, or whichever margins you take. They have been in a certain range which have not fluctuated very widely. Quarter by quarter, because of currency or commodity prices, they may do, but over the longer term those things tend to even out. So whether it is metal prices, steel and aluminum, or tire prices go because of rubber tire prices also increasing, so on and so forth, over a period of time, which typically my sense is about twice a year, all auto companies including Maruti revise their end product prices also to adjust for those I would say input price inflation, if at all, where it needs to be, so that they can maintain their margin. So I'm not so much concerned about it. There may be short-term factors which may affect performance for 1 or 2 quarters, but when the next price revision happens, you see a little bump up in the margins, which that correction happens. So when you look at 4 quarters or an annualized basis, you don't even feel that there was an aberration in between. So from a valuation point of view, which is what we are coming to, it would probably do about 330, 340 rupees of EPS, that is current year, and that will go up to about 380, 390 rupees, that is for the financial year 19-20, and current price discounts at about 26, 27 times current year and about 22, 23 times next year, which when we look at wide range of companies, including Nifty companies, and look at the consistency, sustainability, track record, and the superior quality of the business that Maruti is, it's not too expensive at all. My sense is it's a very reasonable business that one could accumulate on declines.
Okay, before we move on to the next stock, Sangeet, just one word. Since you're neutral on Maruti, is there something that you like very quickly in the auto space? If someone wants to play the auto space, what would you recommend?
Maybe Tata Motors. Obviously, the earnings are under pressure, but looking at the valuation, the risk to reward ratio is in favor of investors to build a new position. You might have surprises either from the domestic business or from the JLR because of the new launches that they are having.
Okay, so I think it's a pretty bullish view that's coming in from 2 of our guests on Maruti. Sangeet is saying that Tata Motors provides a much better risk reward ratio compared to Maruti at this point of time. But we'll move on to the next stock, and that is Engineers India. The counter had rallied significantly last year, but now it's down to almost its 52-week low. It's down to levels of 130. What's plaguing the stock? It's down almost 23% in the last 3 months itself. So the big question we're asking is the bottom made? What's plaguing the stock? So Samir, you go first. What's your view on Engineers India? You have a minute.
So I think the bottom is still not placed up, because if you see the results, the margins came in around at 12%, where it does an average of 23, 24%. So that might have shaken a lot of people, and the performance consistency which it was showing for past couple of quarters. So I think till that gets cleared and that comes back to that 20 levels, I think there will be a certain kind of a downside to it. And because over here, what is happening in these kind of markets, stocks are not finding good buyers who can, accumulate at a certain given prices. So as the prices come down, the buying keeps on continuing in tranches. So I think there is still a downside till the time the next quarter results show the improvement.
Okay, so that's the view that's coming in. Vivek, do you have a view on Engineers India?
Well, I don't really have a view because I don't track it, and the reason for not tracking it because it's difficult to track this company, because here one needs to track the order flow in terms of what Engineers India gets and when it is going to get executed. The order flow itself depends upon the capital expenditure planned by the oil PSUs, which is what gives them bulk of their revenues, because Engineers India is largely focused on engineering services and consultancy services in the hydrocarbon sector, and the largest I would say investors or spenders in that space are obviously Indian Oil, Bharat Petroleum, ONGC, Hindustan Petroleum, and basically the oil PSUs. There you always have a question mark as to when they are going to do the capex, when is it going to get concluded, and so that gives additional uncertainty to Engineers India itself, which makes it difficult to track both in terms of order flow, in terms of execution, when the earnings are going to come, so on and so forth. The only positive I see in Engineers India is that it's a debt-free balance sheet.
Okay.
It has consistently generated free cash flows, and it's an asset-light model. It generates high return on capital.
Okay.
Growth is a question mark.
Okay, growth is a question mark, and your opening statement on Engineers India.
So again, I would avoid Engineers India. As a matter of policy, I have been avoiding public sector undertakings across the spectrum. You may have few companies within public sector units which are actually, doing well, and Engineers India could be one of them. I'm not too sure. The margins last quarter came in low because the focus was more on the turnkey projects instead of the consultancy projects. I think valuation wise it's still pretty reasonable. It makes about 450 crores net profit an annum, and at a market cap of about 8,000 crores with about 2,500 cash on books. The valuation is pretty reasonable, but as a matter of policy I have been staying away from public sector undertakings.
Okay, so I think the consensus view on Engineers India at this point of time is that it's an avoid, which they will wait in for better entry points. We have a question that's coming in from Ramesh Sharma. He's saying, will the upswing in crude aid the stock? Vivek or anyone, Vivek, you can take it. You were speaking about capex and all not coming in, but now since crude is up, there could be, and a lot of their business works in on the hydrocarbon space. So if you can take this.
Well, I don't think there has been historically, if you look at the last 20 years in terms of growth of Engineers India and crude prices, I don't know if, I doubt if one could really draw a correlation between the crude cycle and the earnings of Engineers India, because as I mentioned, the earnings of Engineers India are dependent upon the capital expenditure in the hydrocarbon space, and that itself is independent of the crude cycle, because the oil PSUs who dominate the domestic hydrocarbon sector do the capital expenditure as and when required to take care of the growth. So whether it is on the refining side, whether it is on the exploration side, exploration of course is an open field, and as and when there are licenses given out by the government, investment happens, and investment continues for few years after that. In the refining space, as and when oil PSUs need to expand capacity, they undertake the capex, which is probably a cycle once every 5 years that all of them by rotation tend to do a large capex. But I doubt if there's any correlation to crude cycle over the last 20 years. So EIL would be independent of that.
Okay, Samir, just quickly, you've been tracking the numbers. What exactly seems to have gone wrong for the past few quarters for Engineers India?
So as Sangeet put it, the more revenues come from the turnkey projects, the margins take a hit. What is happening, the order book is there from the hydrocarbons, but what happens due to certain uncertainties or certain assessments back from the company who gives the order execution gets delayed. So over there what happens, the revenue recognition or the order book keeps on going into backlogs and doesn't convert into the revenue. So if the system changes like this, and what happened this quarter, if it continues for 2-3 quarters, then the whole business model takes a shift for a while till the time the the hydrocarbon recovers and the margins come back. So I think the more the turnkey will come into place, the lower the margins will be, and the valuations, whether justified or not, will take a hit, because that's like a transformation of a business for a shorter term or a medium term.
Okay, so I think that's the view that's coming in on Engineers India. It's a clear avoid as per all of the three guests who commented on the stock. The next stock is pretty much the stock which has been in focus, Shankara Building. The counter did manage to correct significantly, then it recovered, it's trading flat now. But clearly the big question we are asking is, the counter has corrected, will you accumulate Shankara Building in this fall? That is what we are asking. Vivek, you go first. You have a 1 minute opening statement on Shankara.
Well, Shankara, I like the business. I am not going to comment on any governance issues or quality of the management issues. I'm purely looking at the business clinically. A very good business that one should be bullish on in the long term. What I'm not bullish about is the valuations. I mean, even today, if we look at the company, the market cap is about 3,500 crores, about 400 crores of debt, 400-500 crores of debt. So you have 4,000 crores of enterprise value. And for last results that they declared for the financial year 18, you had EBITDA of about 175. So you have 23 times EV by EBITDA, earnings 32 times. 32 EPS, and hence you have about 48 times on a historic basis. Even forward looking will be in something like 42 times if I assume about 20% growth rate. By no means cheap. So the business is good, valuation is far too expensive. So I'll wait for the price to correct much more than what it has already done. Okay, valuation concern at this point of time for Shankara, business is good, so it will be accumulated on a fall as per Vivek. Sangeet, what's your view on Shankara?
I would second Vivek's view. I think valuations are way too ahead. It's a very, very low margin business. The EBITDA margin they make is about 5 to 7%. Remember, they don't own any brands as such. They are trying to develop some, but large part of the business is still retailing and distribution of building products in South India. You have other players at maybe little cheaper valuation which actually own brands in the building product space. The same store sales growth has been very high, about 16 to 20%. Looks too good to be true, but again on valuation principles, I'm avoid to the stock.
Okay, what about you?
So I would avoid the stock because for me, see, in this kind of a downturn or any kind of reactions happen, if you have certain kind of working capital issues and the business might be doing well, the valuations don't justify, because the valuations are more of a consumer-led kind of a business valuations where it's more B2B. I think even if they develop their own brands, that requires another costing. And if you already have debt in the system and your cash flow generation is on the lower side, I think that affects the whole system, and I would avoid it.
Okay, so it's an avoid by what Samir has said, but the other two guys do believe that they like the business, but valuations are extremely expensive. We have a viewer query, and Abhesha is saying stock has fallen. Is there anything in the financials that cause a bit of a concern? Has anyone seen the financials when the fall came in? Is there anything that should be of a concern? Anyone can take it.
So financials, whatever I have seen, see, in these kind of falls, you have to see three things. Whether it has debt, it does. Whether there are related party transactions which have been done at a larger scale. The only related party which flagged off internal in our assessment is that there is a due from directors around 20 crores. So that can be a loan which is given, but I won't raise the concern that the whole company financials are a no-go. And the third is, it's not a consumer business, so the working capital requirement as it grows will keep on growing higher. So somewhere they have to address the cash flow generation. So otherwise, I haven't seen any red flags other than that which can be raised out.
Okay, so no red flags at this point of time. Sangeet, what could be an ideal valuation for someone like a Shankara Buildcon? It's trading at much cheaper, higher valuations according to you. And what would be, at what level will you start accumulating?
So I would rather prefer somebody which is a branded play in the building material space rather than a distributor or a retailer of sorts. You know, for instance, maybe within the building material space, players operating in the CPVC, UPVC segment because that's where I think a large portion of growth is going to come from in coming years. So as such, I don't think I have a price target to accumulate Shankara building at lower levels.
Okay, so you mean the company is like an Astral Poly?
Astral again is, it's a great business, valuation again is a concern. Maybe an Apollo Pipes, which is again in the same business, looks to be a better bet.
Okay, and what about you? Do you think that what could be the trigger and what kind of valuation will you look at? If someone wants to accumulate Shankara and you find the valuations expensive, at what valuations is it an ideal accumulation level?
Well, if I were to really give that price, I mean, either people are going to laugh or never go, or unlikely that you're going to be able to buy it in the near term. I wouldn't buy this at more than 500 rupees, which is about 14-15 times earnings.
Okay.
So that's since you asked me what price I would buy, well,
fair.
that is
That's
not
fair,
more
that's
than
fair.
so which is what I said. So either it's laughable, or one would have to wait for a very long time for those prices to come, and even if they don't come, I'm fine. I don't buy it. Simple as that. But I don't have to buy a business which earns 15% return on equity at 45 times earnings or 48 times earnings. But I would second the view that Sangeet has got, that it's much better to stick with branded businesses within the and one need not necessarily be looking only at the building materials, but overall the key thing is that the companies have to have got to be debt free and be free cash flows, as Samir mentioned, have return on capital, return on equity upwards of 20-25% preferably, and there are enough number of companies that one can look at within the building materials. And why not look at the paint companies? Asian Paints, which has got a stellar track record, maybe much cheaper on valuation multiples, and is a terrific franchise to look at. So I mean, I would probably stick to the paint companies within this building materials if I have to, or a related space stuff like Havells also is something which appeals to me.
Okay, so that's the view that's coming in on Shankara building at this point of time. All three of our guests won't accumulate Shankara Buildcon at this level. Mainly valuations are a concern at this point of time. And the last stock, again, a stock in focus, and that is Manpasand Beverages. It has fallen significantly. It's down another 5% in trade today. The big question is down 75% in the last 12 months, and it's been going down significantly post why the auditor Deloitte did manage to resign from the company. But the big question is that at this level, is it something that you would accumulate, looking at the financials, looking at what the company has clarified? That's the question we're asking. Samir, you go first. Would you accumulate Manpasand?
So not at this price. If you single out the business, we've been assessing it since IPO times, and physical verification and everything is there. I would buy it at anything below 150.
Okay.
So I would start over there because that was the IPO price post-split, if you see into that. See, the only thing is, if as in on the resignation, the auditor was already there for 8 years in the firm. Second of all, the debt is not there. They paid the debt in FY16 when they got listed. Thirdly, they're putting capex. They always, and so fourth, the main issue with them is they are present in under 10 rupees kind of a product line. Over there, the pricing pressure will be always there, and they won't be able to increase the prices, so they always play a volume game. So which I'm more interested in, and I am frankly sorry to say, but I was waiting for this kind of a fall to come in because the rationalization of valuation.
I think your time is up, but I'll come back to you. What about you, Vivek? Manpasand, any view?
Well, I'm absolutely going to avoid it, come what may, in terms of, I would say for a long time I'm going to avoid it. I mean, there are serious credibility issues where the management needs to now come out clean. Not that the auditors have raised any issues in the public domain. I mean, all they said was they were seeking information which they didn't get. But what was that information which was so critical that leads them to resign after 8 years? So what is it that for 8 years they found okay, and in the 9th year they found that now this is not okay? So even the auditors need to come out clean. Now, between who comes out clean, I as an investor, for me the simple thing is the choice between losing an opportunity and losing money. I mean, for me the choice is obvious. I simply let go of the opportunity because I can definitely find some other opportunities than to lose money if things were to get more ugly. Quite likely things will get more ugly in these kind of cases if we look at precedents, and there I'm reminded of Charlie Munger's cockroach principle.
Okay,
That
your time is up. I'll come back to you on that. And your opening statement, do you have a view on Manpasand?
So I don't have a view on Manpasand. I believe there is no smoke without a fire. However, I agree with Vivek's view that I think the auditor needs to come out clean here as well. See, auditors have an option to qualify their report. And it's really surprising that auditors have not listed any sort of reasons besides non-availability of information. What kind of informations were not made available since they were auditors for last 8 years? It's really surprising that they just resign without stating, without giving investors a fair view that what all information was hidden from them. So, but I don't track this stock, and I think it's better to stay away maybe.
Okay, and so with that, I think it's all of the guests are saying it's an avoid. I'll come to you, Vivek, and I think you should answer this question because I think it's something that you were answering. Vivek Nair is saying, should such stocks where we have auditor concerns be totally avoided, or does it make sense to do bottom fishing? I think that was exactly what you were speaking about, and you can answer, Vivek.
yeah, Vivek to Vivek.
Yeah.
Well, there are two things. It is not that auditors raise any concerns and the stock has to be avoided, because if you were to go by that filter, probably 99% of the companies will start getting avoided if you start combing through all the audit reports and get down to those details. But see, in this case here, it's a loss of credibility. Today the market participants don't trust the numbers that Manpasand has put out or will put out in future. So management has got a serious task ahead of itself to establish the credibility in terms of the business that they are doing and whether those numbers can be trusted or not. Now, just before the opening remarks, as I mentioned, I'm reminded here of Charlie Munger's cockroach principle, that when you spot a cockroach, it's never only one cockroach. You start cleaning up and a whole host of cockroaches come out. If we look at corporate history over the last 20 years, and a whole lot of companies have been in a similar state, it's not the first time a Manpasand episode came up. Just few weeks prior to that, a PPC Jewellers also had some similar issues related to the numbers, related to corporate governance. Vakrangi has always been. So in 2018 itself, we have had 3 live examples of high profile stocks, high flyer stocks. And this is unlikely to get over very soon. So a lot more cockroaches will come out, a lot more skeletons will tumble out. So which is the reason I say I would clearly avoid such companies, because it's very difficult to do bottom fishing. You really don't know when the stock will bottom out.
Okay, we need to wrap up the show very quickly. Samir, your final word, is there anything in the financials that caught your eye that there's something wrong here?
No, nothing as far as we have seen or we've kept on looking. The only thing was the debt was hanging, which they repaid, and they've done a QIP which is going into the capex. So I don't think so. But the only point is, it's a very high risk appetite kind of an investment to be done. Even we do it generally in small bits. So we've done that in SpiceJet when the crash was there. We've done that in MCX. So I think it's there. It takes a little time to come up. We've done this, and our internal systems don't raise that kind of red flags.
Okay, so I think the consensus view again on Manpasand is a clear avoid at this point of time. Better opportunities, as what Vivek spoke about. But with that, it's wrap on today's Hot Money. Sangeet, Samir and Vivek, thank you so much for joining me on the show. Ask BQ comes up next. Stay tuned to Bloomberg.